Well, good afternoon, ladies and gentlemen, and welcome to our webcast focusing on our work in real estate, both here in Canada and in the U.S. It's our pleasure to have as our guest today our partner, John Foresi, who's the CEO of Venterra Realty based in Toronto, and the managing director of our own real estate group, Mark Hanna, who is based here in Vancouver. Just before we get started, I wanted to maybe provide some context in terms of where we are with respect to real estate, and in particular how the year 2022 has gone, because it is quite extraordinary. Nicola Wealth Real Estate has actually been managing real estate for well over 20 years for our clients, and our focus has been to create cash flow and wealth through real estate. And where things sit right now is our team is managing $8.7 billion worth of real estate, over 225 assets across Canada and the U.S., covering about 19 million square feet. And we've added about $1.5 billion of assets in the last 12 months. These are where our assets are located. As you can see, it's well diversified, but there is a focus between Western Canada, Eastern Canada, and as you can see, the South and Southeast portions of the United States. The managing director of our real estate team is Mark Hanna, and this is a little bit about his background. He started his career at Cushman & Wakefield in 1981, and he created, a few years later, the office of Avison & Young in 1994, ultimately becoming its managing director. He joined Nicola Wealth in 2003 to acquire a shopping center in Calgary for $15 million, and then manage that shopping center. As I mentioned before, now Mark oversees assets for the company, actually worth now $8.7 billion in North America, and he has a team of 60 professionals and specialists who work with him. This is some information about our primary real estate pools. The first is our Canadian Real Estate Fund, which has actually existed since 2005. And what you're looking at is a graph comparing it to the TSX REIT Index, which is an alternative way of buying real estate in Canada in public markets. And down below, you'll notice that this is the difference in return between our real estate pool and the REIT index, which amounts to approximately 3.7% per year outperformance over the last 17 years. And that has been accomplished with 80% less volatility than has been experienced in the REIT index. And you especially notice that volatility this year, where it's been quite extreme. This is a graph of our real estate pool, Canadian real estate pool, against the TSX REIT index, but just for this year, for the 9 months so far of 2022. And what you'll notice is there's a really staggering 50% difference, a difference actually that we've never seen before in the performance of our Canadian Real Estate Fund year to date versus the TSX REIT index. The Canadian fund is up 13% year to date, while the TSX REIT index is down almost 25%, which will no doubt create some interesting opportunities for us as we go forward. One of our other funds is a value add development fund, and when it's compared to the REIT index, the difference is quite significant as well. It's a shorter term fund. It's only been in existence for 7 years, but over those 7 years, it has outperformed the TSX REIT index by about 9.4% per year, again with significantly less volatility. And then ultimately we have a real estate pool in the US. It's a spin-off that came as a result of our original fund in Canada in 2005. It was spun out into an independent fund in 2010. And since that spin-out has occurred, there has been, when compared to the US real estate ETF, which is an iShares publicly traded fund, the 4.1% a year gap between that fund and our performance in U.S. real estate, and again, a significant difference in the volatility of approximately 80%. Now, a large part of the reason for that significant outperformance in the U.S. Is to be credited to our most important partner in the U.S., which is Venterra Realty. Here's a little background on them. So it was founded in 2001 by John Foresi and Andrew Stewart. Its focus is multifamily residential assets in the U.S. South and Southeast. Very much focused on value-add investment in both acquisition and asset management. a top-rated company, both in terms of leadership and as a top employer by Glassdoor, Fortune, and other organizations, and mid to high double-digit returns to investors over the last 21 years. Currently managing approximately $5 billion US in assets throughout the U.S. And the person who was the co-founder of this organization, who's with us today, John Foresi, has a very impressive CV of his own. So as I mentioned, he's a CEO and co-founder of Venterra, top 40 under 40 winner in his younger days, Glassdoor recognition as a top CEO for companies under 1,000 employees, past chapter chair of YPO Ontario Gold Chapter, actively involved in both the Chief Executives Organization and Tiger 21, and he has an MBA from Harvard and a business degree from Wilfrid Laurier University. John looks at assets for investors. He looks at it first from a strategic macroeconomic view and then decides how they're going to acquire and then manage assets. So with that in mind, what I'd like to do, John, is pass this over to you and ask you, maybe you could first take a look, if you would, at where you see things from a top-down macroeconomic point of view. John, over to you.
Well, thank you, John. I'm going to focus in this next 20 to 25 minutes or so. I think we'll do it through the whole session, but really breaking out the noise, which there's an awful lot of noise out there in the markets currently, from the signal. The signal is what we really need to pay attention to in terms of giving us direction on what the market's saying and the investment actions we should take. So I'm going to focus on 5 macroeconomic themes that actually translates into the way that we make our investments. And that's, like I said, it's going to be about 20 to 25 minutes. So there's a lot of turmoil out there. And if I try to answer the question, what is causing this turmoil? It really is, for me and for Venterra, it's down to one topic, which is debt. There's simply too much debt in the world. To take the ratio of global debt to global GDP, in 2007, that level was 269%. And then the markets capitulated. The bond market and the debt market said there's too much debt in the world. So we have that as a benchmark. 269% is too much. We were supposed to use the financial crisis as an opportunity to delever. And we did exactly the opposite around the world. We increased debt. So by December 2019, it was 318%. And then COVID hit. And there was a lot of federal stimulus around the world that was provided into the markets, and the debt levels went up to 365%. And the only reason the markets did not capitulate is that governments for the last decade plus have been artificially suppressing interest rates, because there's no way that the interest rates that existed in 2007 could be carried by the world economy at this kind of leverage level. And because of all that stimulus, the debt levels have gone down minorly over the last year. So currently we're at 352, but clearly too much debt. So this is a problem that still has to be fixed. So the clear signal here is that we have too much debt. But what are the actions that have to be taken? And since the global financial crisis, and even before that, the Venterra's approach has been to use much lower debt than is the norm in the marketplace, have high cash balances so that we have the opportunity to pounce on investment opportunities when they present themselves. Those are our strategies. Another action is that over centuries of economic and investment history, now is the time to pounce. Now is the time to lean in. And that maybe uncomfortable feeling that you're getting in your stomach are whispers saying now is the right time. Asset prices are down 10 to 15%, which is very large in our marketplace. And that's presenting, if you can get in at the right price, really attractive buying opportunities. And the right entry price point is really critical, of course, but that's what Venterra and Nicola have got expertise at. Over multiple decades, we've been able to focus on that successfully. Another action, when there's this much debt in the marketplace, is that we strongly believe do not make investment decisions on probabilistic outcomes. It's X% chance that the bubble's going to pop or whatever. No, we just always assume that the worst case scenario will happen. And can your assets survive that worst case? Worse than the financial crisis. And only then when we stress test in their conditions that are worse than the financial crisis, that we are confident that we can get all of our investors' money back, then that becomes an interesting opportunity that we will consider. If it doesn't pass that test, we don't continue the analysis any further than that. All right, so capital flows. Every number that I show in this chart is a signal from our perspective. And so it's screening in terms of providing investment direction. So over the decades of investment experience that we have, we've learned a lot. One of the most important things that we've learned, or the concepts, is following long-term capital flows. If you can follow long-term capital flows and determine where they're going, your chances of earning alpha returns are much, much higher. So the signal is where the capital is flowing. And what kind of capital are we talking about in this particular slide is FDI, or foreign direct investment. And we picked this kind of capital because it's kind of like a free-willed vote on where the world is investing, other than their own country. It's kind of like a read on economic democracy around the world, if you will. And so these FDI numbers that I'm going to show you are 3-year annual averages ending at the end of 2021. And that's an important point because it's pre the Russian invasion of Ukraine in February of 22. So I can assure you that the numbers that we show here for America are only going to have been stronger, and the numbers for China and Russia will be weaker than they're showing in this chart. And so FDI is a really important indicator for long-term investments because it's a key driver of productivity growth. And productivity growth is the magical elixir of wealth creation for both labor and for capital, and we'll get into that in more detail. But FDI has been growing for about 3% per year for the last 3 years in Europe. Kind of a mediocre result, but it kind of goes along with everything economically in Europe. It's a beautiful place, but economically it's mediocre. And then Russia. Before the invasion, they were limping along at just 0.5% of FDI growth per year. You can rest assured that number is dramatically negative now. And China is only at 5%. And with lockdowns and geopolitical isolation, I mean, you know of many firms that are investing in China now. FDI is going to be below that number. And Japan's at 4.7%. And for decades, Japan has had its economic feet in the mud. Now, Canada has done relatively well to these other jurisdictions, growing their FDI at 5.3%. So that's good. The only issue there, it's a big issue, is that Canada doesn't compete with these other jurisdictions. It competes with America because 75% of Canada's trade approximately is with America. And the American number is 11%. And like I said, that's a spectacular result in itself, but it's going to be higher right now because the onshoring that we're seeing in real time, which I'm going to give some examples of in America, is staggering. And you may say that, well, that's a small part of the geography of the world, which is true, but it's a huge part of the economics of the world, and that the jurisdictions I've just indicated are over 75% of the world's GDP. So a couple of points to highlight here. 20% of the FDI inflows into Canada are manufacturing related. 40% of the inflows that are happening in the States are manufacturing related. And we really like following manufacturing capital flows, which I'll highlight in a second. So domestic business spending. So we've talked about foreign direct investment. In the States, domestic business investing, so American companies investing in America, has gone through the roof as well. It's at about 13.5% of GDP, which is at the same level way back when in the Reagan administration. And I think a number of us are old enough to remember how good the economy was under the Reagan administration. But domestic business spending in Canada is only at 8% of GDP, or 40% lower than the level it's happening domestically in the U.S. In the U.S., manufacturing is only about 11% of overall U.S. GDP, but it drives, this is why we're interested in it, 35% of productivity growth, 60% of exports, 70% of R&D, private sector R&D, and that's just traditional manufacturing. It doesn't include digital products or software, which are enormously important and sectors that the U.S. has an incredible advantage in dominance of globally. It's a critical space for America that they keep increasing their domination of. Okay, this is the signal that I want to leave on this particular slide, is that this is the greatest reindustrialization period for America since the Second World War. This decade is going to be remembered in America 100 years from now as an inflection point for American prosperity relative to the rest of the world. If you look at Apple, really big company, biggest in the world. They're the size of a country. I think their GDP or their market cap is bigger than, say, Canada's GDP. So it's a huge company. 2 years ago, Apple had 25 domestic suppliers, i.e. suppliers in the US for its products. Last year, that increased from 25 to 48, almost a doubling. And then an incredible stat here is that if you take FDI, you take all the domestic business spending and CapEx, in Q2 of this year, spending on construction of manufacturing facilities in the States was up versus a year ago by 116%. That's not a misprint. So where do you think all this manufacturing investment dollars are going? Not a lot is probably going to Illinois or to California or to New York or to Connecticut or to New Jersey. They're going into the markets that we focus on that are business friendly and conducive to great investment returns. So that's certainly strong signals. Question, is a near-term recession inevitable? Of course, we get this question on a daily basis. And so the answer to that, I won't evade the question. It's not inevitable, but I think it's very, very highly likely that we will have a recession. If you're a trader in the sense of buying and selling, holding for short periods of time, determining whether there's a near-term recession is an important question. But if you're a long-term investor like we are, it really is just noise, and it's not the signal. We fundamentally disagree with the strategy of trading real estate for short and holding it for short-term periods or flippers or whatever you want to call it. We actually like when lots of investors do these real estate short-term holds because it makes it easier, quite frankly, for us to make better long-term returns. It's just a strategy that we think is fundamentally flawed to take a long-lasting asset like real estate and hold it for short periods of time. If you're a long-term holder of real estate, the recession becomes noise. The signal is what I had said in the first slide. Use low debt levels and buy now or lean in because the opportunity to get attractive returns, if you can get the right entry price point, is very, very, it's opportune, basically. We don't know when a bubble is going to pop. We are in a bubble, a debt bubble, as I indicated. But being out of the market is disastrous for your long-term returns because you can never tell when the strong recovery is going to happen. And we highly recommend staying in the market with low debt levels. It's the proven way to earn superior long-term returns. It is not the U.S. that we're actually worried about in a recession. It's the rest of the developed world and the developing world, which the rest of the developed world obviously includes Canada. For the U.S., it's going to be really difficult to have a deep recession. Not that it's impossible, but it's going to be difficult to have a deep recession with the kind of foreign direct investment and domestic CapEx spending, which I already highlighted in the previous slide, that's occurring. Here is why recession talk is the noise for long-term investors in multifamily assets. We try to quantify this. Time heals wounds. So this is a simple, basic underwritten multifamily deal for Venterra. And so if you look at the yellow highlight, that's a 15% rate of return on a 7-year modeled hold period, even though we hold for longer than that. And that's up about 100 to 150 basis points versus what we were underwriting even a year ago because the market's more attractive right now because of the turmoil that's going on. So let's make an assumption that we're buying this asset, this theoretical asset, at 4.5% cap rate, and NOI, net operating income, which is cash flows before financing costs, is what's used to determine the value of a real estate asset. Let's assume that NOI is growing at 4% per year, which is very reasonable. We've achieved it for decades, so it's not like a wild assumption. Let's also make the assumption that the day after we buy this asset, the value of the asset goes down by 10%. Not likely, given that asset values are already down 10 to 15%. But it's a possibility, and we want to use a draconian situation. Well, if you're a short-term holder of assets, you're a flipper of real estate, then you're in trouble, right? Timing is everything then. And if you hold it for only 2 years, your returns are decimated. You get just over 3%. You've got a 1,300 basis point reduction in what the IRR would be. And of course, you see in the baseline scenario, the IRRs go down the longer the holds. Time is somewhat the enemy of IRR, but they don't go down by that much. But you're really losing out relative to what your expectations were. If you hold it for 7 years, again, the NOI of 4% just keeps creating value over time. As long as you're patient, the returns can be quite attractive, usually are. Well, now you're off of your original underwriting of 15%, but only by 2.6%. And then if you hold for 10 years, the pain gets even less. Your original underwriting for 10-year hold was 14.4. You've only missed that target by 1.5%. So that's an important sort of paradigm to understand, that real estate is a long-term hold business, and the longer you can hold, the less you have to worry about the noise of a recession. Now, I want to just end this topic about a recession as it relates to the differential between Canadian real estate and U.S. real estate. And I'm a Canadian, and I'm a proud Canadian, but I'm here to sort of try to talk dispassionately about economic and investment decisions. And so you can see, everyone knows that real estate is, residential real estate that is very highly valued in Canada. And you can see, if you take just a multiple of the median house price divided by the median household income, in Vancouver, it's about 14 and a half times. In Toronto, I guess it's about 13 and a half times. And if you take a city like Houston, which is where our head office is, and again, we only hold U.S. multifamily assets. That's what we're hyper focused on. Houston's bigger than both Toronto as a city and Vancouver. It's only 6.5 times. And so it's gone up. The multiple's gone up there too, but it's less than half the price on a relative basis than the real estate in Canada and in the Canadian markets I mentioned. So here's some really important things to consider in terms of your exposure to the U.S. So household debt as a percent of disposable income, as we learned going into the financial crisis of 08-09, was a critical measurement down in the States. Well, in Canada, it's the flip. Canada was much more conservative going into the global financial crisis of 08-09 than the U.S. was. But it's flipped around this time. So that measure of household debt is now 186% in Canada. And if it's even more so than it was in the U.S. before the U.S. went into the housing crisis. So at the peak in 2007, it was 165% in the U.S. Currently in the U.S., it's only 101%. So the household financials in the U.S. are on relatively strong footing going into this potential recession. And then residential investment as a share of GDP in Canada is twice the level of that in the U.S. And so the U.S. single-family housing market is vulnerable, and it happens to be more important to the overall economy than it is in the States. And those are things to consider about where you're going to have your increased exposure going into this potential recession. Okay, so why inflation worries are noise as long as you're a long-term multifamily investor? Now, again, all the talk is about inflation. How can it not be? But if you're a long-term real estate player, it is not the signal. The signal is that multifamily rental growth rates in the U.S. over any long period of time relative to the CPI index beats inflation, making multifamily real estate one of the best inflation hedges available in the marketplace. As a multifamily real estate investor, we actually like inflation. Consider this, our leases reset approximately once every year. I'm going to show you. They inflate at rates greater than the CPI. Yet if you use relatively conservative leverage, which is what we use, of say 65% loan to value, 1/3 of your cost structure in a multifamily asset is fixed. It's, because we use 7-year or 10-year for the most part, fixed loans or mortgages. And so those costs are flat. So when you have 100% of your revenues inflating at greater than the rate of CPI, and you have 1/3 of your cost structure fixed, your growth in your distributable cash line is significantly faster than overall CPI growth over time, which makes the asset, if it's well bought and well managed, an incredible inflation hedge. So let's take a look at this chart. There's a lot to digest here, but again, I'll try to move through it quickly. So what this is showing, the blue line, we've been able to put through multiple time series together to get almost 50 years of historical U.S. apartment rental annual growth rates. That's the blue line. The black lines are the average CPI during that period of time, excluding rent. Rent's something like 7% of the CPI component. But we're trying here to compare what rent growth is relative to the rest of CPI or the rest of inflation. So we didn't want to mess it up by keeping rent levels in the CPI calculation. And so you can see this, that most of the time, even in the very high inflationary periods of the 70s, that most of the time, not all the time, but most of the time, the blue line, rent growth rates, are above the black line, which is the average CPI level. And again, sometimes it goes down. But how does multifamily, oh, here's the other thing I want to highlight to you that I think just sort of brings these numbers together. If you look at any period of time over any lengthy period, you will find that rents exceed CPI. And so if you take the turn of the century or just before the dot-com bubble busted to after 22, after COVID ended, rent growth beat CPI by almost a full percentage point. That's in the top right corner there, 0.9 percentage points. If you take the start of the financial crisis to the end of from 08 to 22, the end of the pandemic, 1.8 percentage points, which is a huge differential. If you take, after the financial crisis of 2011, but before COVID, you get 2 points, 2 percentage points. And if you take after the financial crisis, but the end of COVID, it's 2.4 percentage points. Any way you slice this over any length of time, rent growth has beat CPI. That's sort of somewhat an incredible track record. So how does multifamily rental pricing growth outperform CPI inflation sustainably over long periods of time? There's really two broad answers to this question. First, the U.S. has a long history of being maniacally focused on strong productivity gains. You cannot be elected as a president. You certainly cannot be reelected in your second term as a president without the demonstrated capability of having strong productivity growth, which allows wages, that's why it's important, to grow faster than the inflation rate without being inflationary in themselves. So why is this? Because the workforce, when it's producing more with less, producing it faster, producing higher quality, that's productivity growth. Business owners are willing to pay labor more than the inflation rate because the owners of capital themselves are making more profits because total unit costs of production are growing slower than inflation. So since wages can grow faster than inflation when there's high productivity, rent is in essence paid with wages, so rents can grow faster than inflation. Second, housing is a necessity of life, as we all know, and it's also supply constrained versus many of the other items, more supply constrained than many of the other items in the CPI inflation basket. It's easier to ramp up the production of, say, a widget in a factory by adding a second or a third line. It's not so easy to get a new rental product to market. Bringing a new property to market is like building a whole new factory with all the red tape and long lead times in terms of permitting and entitlements and those kinds of things that are necessary to get the property up and running and rentable. So higher rents absolutely do bring new supply to the marketplace, but supply takes time to materialize, and excess supply tends to scare thinly capitalized merchant developers who represent approximately, in our markets, 75% of the production volume or the new supply volume in our markets. The experience of the global financial crisis is burned into the minds of these merchant developers. So strong rent growth and demand now That's one thing. But merchant developers always keep an eye to the uncertainty of demand and pricing 3 years out when their product is going to come to market. A badly timed deal can financially cripple or threaten these small developers. They aren't built, quite simply, to hold on to these assets for long periods of time. They simply cannot afford to, and it causes skittishness in terms of bringing new supply onto the market. So over time, supply consistently lags demand in multifamily. So the result is a long-term picture where rent growth is consistently greater than CPI growth, plus a phenomenal history of American productivity growth. It allows wages to grow faster than CPI, and it allows rents to grow faster than CPI. And so here's three differences I want to highlight between the perhaps the single-family market in Canada and the single-family market in the States. And Canada is I'm sure very attractive relative to a lot of places around the world. But just in the comparison, because I live in Canada and I invest in the States, here are some important things to take into consideration. Okay, so if productivity is the magical elixir that allows wages to grow faster than inflation and allows rents to grow faster than inflation, what's the driver of productivity? Well, ground zero is R&D spending. And over the long term, Canada has spent about 0.5%, a little more than 0.5% of its GDP on R&D. The U.S. over the long term has spent 3.3% of its GDP on R&D. A big difference. Excuse me. It's about 5.5 times on a relative basis bigger in absolute terms, because the U.S. economy is about 12 times the size of Canada's, about 60 times as much in R&D. So the U.S., and of course, this all translates into productivity. One of the best measures of productivity is not GDP growth, but GDP growth per capita or per person. In the end, that's an income that's generated by the average person that gets divided between capital and between labor. And if that's growing strongly, then a lot of good things can happen and living standards rise. So in the US, the GDP per capita has outpaced Canada's by 50 basis points on average for 40 years. So 0.5% more per year. Over a 40-year period, the differential is quite staggering. So this supports, again, wage growth and rent growth. And of course, in all of our markets, there is not rent controls. And so you'd say, well, that means that developers and apartment owners like us can take advantage of renters. And that's absolutely not the case. Pro-housing development, i.e. lower regulations around housing development, allows the market in terms of supply and demand to be more balanced than it would otherwise be. If you look at our markets, one of the strengths of them is that housing is exceptionally affordable and has been that way for decades because incomes are growing faster and supply comes on when there's higher demand and they're not encumbered by political activities. So, okay, now this next point. Water, not everywhere, where to avoid. The noise in the marketplace is really about the gateway markets and the popular markets as it relates to multifamily investing. The signal is what cities are going to have access to water. And I think you'll find this section of this topic interesting, that fresh water, that is. So let's just take you through a couple slides. This is the census from the US in 2020. So it covers the previous 10 years. And the green areas highlight markets or areas that had higher population growth. And the brown areas highlight areas with lower population growth. I am relatively confident, I'm very confident, that when the new census comes out in 2030, you will see green areas, a number of them, flip to brown areas, and you'll see a number of brown areas flip to green areas. The last 30 years was about migration for economic opportunity and lower cost of living. The next 30 years, we believe, will be about migration for water availability, which will lead to economic opportunity and a lower cost of living because water is very expensive if you don't have enough of it. Okay, so maybe the most impactful slide that we've come across in the last couple of years. This is in Central Valley, California. If you go inland from San Francisco, you'll hit the agricultural breadbasket of the state. This is put together by Professor Jim Salzman of UCLA. And so, you know, everyone knows California has a shortage of water, yet it's effectively exporting 100 billion gallons of water a year, 15 billion gallons of water a year to its geopolitical rival, China. How is it doing this? It's doing it because they grow an awful lot of alfalfa, which is a water-hungry plant of low value that gets fed to cows and livestock around the world. And so they export this product to other places in the US and other places in the world and to China. And so what this picture depicts is that this individual it was taken in 1977. So they're standing on the Central Valley and where that land was in 1977. And you can see at the top of the chart, it says 1925. That's where the land was in 1925. Because what happens in the Central Valley, there's droughts and there's more and more droughts. And they pump water out of the aquifer. And they have something that's called subsidence, and I get tongue-tied in that, so I just call it smushing, but as a layman's term. But what effectively happens when they pump the water out of the aquifer, the clay-like structure of the land in the Central Valley compacts and turns into rock, and it really permanently destroys the water holding capacity of the aquifer every time they do these big pumps out of the aquifer. Now look at this chart. So Professor Salzman superimposed another picture that was taken in 2015. So the last picture on above, the first one I showed, ended in 1977. And this is showing how much the land has further declined since 1977 to 2015. And so if you eyeball it, to me it looks like about a 75-foot reduction in where the land is settling at. And it keeps going down. And the amount of destruction of the water holding capacity of the aquifer is absolutely staggering. So that is, I wanted to move on to just something about Canada, and that there's something really good happening regarding climate change in Canada. I mean, it's not good because it is climate change, but the growing season in Canada is increasing. It's an indirect benefit of climate change. And so you can see the chart at the bottom, which shows the relatively consistent line of increasing number of growing days in Canada. If you look at the top left chart, look at the prairies. The dark brown areas are the areas that have the longer growing season as of 1980. Look at the top right-hand side, and you'll see how much the dark brown area has expanded. So in the prairies, you're getting more productive land, longer growing season per acre, and you're getting more acres that can be grown. So that's all happening in a world that's short of food. I focus on our niche, U.S. multifamily. To me, at a distance, this looks like a good real estate bet. Long-term holds of prairie farmland. I think it's only going to get better as long as the climate continues to warm, which unfortunately it seems like it's going to happen. All right, so this is maybe the second most interesting chart that we've come across in the last couple of years, and it certainly has implications for real estate investing. And so as far as we can determine, the amount of precipitation in the U.S. has not changed across the U.S. over the last 30 years. At least we haven't been able to measure that. But where the precipitation happens has changed dramatically. So it's getting drier in the west and wetter in the east. And you can see darker brown patches here. It's 4 inches or more of less water per year. And the dark green areas, you can see where they are, 4 inches or more precipitation per year from 30 years ago. This is a profound impact on what is going to happen. And so America will see farmland shift northward and eastward as drought devastates the west. And it's going to be the opposite of the old saying of go west, young man. It's going to be go east, young man. And the lack of water is going to start to push a growing population into a smaller geography in the U.S. So that's where I want to stop it now, and I think I'm going to turn it over to John, who I think we're going to start off with some more sort of informal discussion of various more detailed topics. So, John, over to you.
Thanks very much, John. No doubt about it. The information that you present is really insightful and thought-provoking. Um, just before we segue, I wanted to segue into a discussion with Mark bringing up our our long-term relationship with Venterra and how that has worked. But just before I do that, John, I wrote down a couple of notes here, and I want to maybe to summarize what I heard as in your presentation and try to encapsulate it into 6 or 7 factors that make the case that you're trying to make. So let me go through them and see if you agree with it. This is a summation of what you see. So number one, the U.S. has better GDP growth per capita than Canada and arguably many other countries in the world. Number two, the U.S. is a recipient of capital, foreign direct investment at a greater rate than most other countries in the world. It has better demographics, again, than most other countries in the world. And it has specific geographic locations you just pointed out, which have or will have higher access to water and are going to be better positioned from a climate change perspective. And you see multifamily as an asset class having, let's say, relatively better ongoing performance, especially on a risk-adjusted basis. And in addition to that, the U.S. is generally, from a relative perspective, more affordable in housing terms than Canada is. And finally, and most importantly, and this is maybe where we're going to segue into a discussion with Mark, that Venterra specifically has an ability to add value, both in terms of the existing assets it acquires and in build-to-own assets. So would that be a reasonable summary of the key factors that make the case for investing in this asset class and
Yeah,
with Venterra in this space?
yeah, those are definitely points that I support and agree with, and the importance of eliminating noise via that's created by having a short-term asset hold perspective. I think that's one of the big enemies of real estate investors, and that it's a long-term, it's an asset meant to be held for the long term, and you get yourself all tied up if you try to time the market and hold these kind of assets for short periods of time. Is the other thing I would add.
Okay. Well, I'm just going to bring up these slides, and Mark, if you're ready,
My presentation is going to be 6 to 7 slides, so I'm going to keep it brief, and it's really on the history of the relationship between Nicola Wealth Real Estate and Venterra Realty, and we've got a long, rich history. But we didn't initially start by jumping in with both feet. We actually just put our toe in the water, and you can see with the very first acquisition in 2006 was a Hunt Cliff portfolio in Texas. We only had a small piece, which is 5.5%. And then we moved on to 2007 to the Waterford portfolio, 9 assets in those various markets. And then we moved on into 2007 to the Waterford portfolio. It had 9 assets in various markets. And again, only a share of 3.88%. And that continued on with our momentum into 2008 with the Bent Tree portfolio and Bristol Heights. And you can see we're starting to up our position in the investments with Venterra. And then finally in 2009 with Champion Woods in Texas, 186 units, and now we're trending upwards of 16 to 17% in each deal. Now, the reason for that is because Lehman Brothers was their capital partner. And of course, with the financial crisis, a lot of us will remember that Lehman Brothers is no longer. So I think John Foresi will agree that we've been a pretty good partner for them and reliable over the last 16 years. So moving on to the next slide here, this gives you an overview of all the assets really since, I guess, 2010. And that's because all the assets prior to 2010 that we acquired together have been sold. And in fact, from 2013 to 2022, we've sold 32 assets in 5 different states. That's almost 9,000 units, or 8.3 million square feet. And on the chart, you can see that we really first started investing with Venterra in Texas, and then we moved on to Georgia. We then added Florida, and then later on North Carolina, Tennessee, and Kentucky. So this chart here shows sort of the breakdown of the pie chart. We've got 77 assets as of right now in the portfolio, and that's spread over 7 states for a total of 21,600 units. And that's 21.5 million square feet of residential space, and some of those properties also have a retail component, so that's just under 100,000 feet in total. And as of September 30th, 2022, the occupancy is around 93%. This chart here shows that where we're at today with the current portfolio. I think you heard John Foresi mention earlier that the total portfolio is just under $5 billion. That's correct. Our portion of that portfolio is just under $1.8 billion. This chart shows the really our position within the portfolio from both an asset value, debt value, the total equity, and the number of units, and they're all in that 37 to 38% range. These are 2 acquisitions recently that we've completed this year, or recently. The Luma Headwaters in Orlando, Florida, 328 units, built in 2020. The deal size was $98 million, and Nicola Wealth Real Estate is 25% of that acquisition. And then also very recently, Anatoly, that's in Daytona Beach, Florida, 208 units, built in 1986. The deal size was $37.25 million, and our portion was 25%. And lastly, to help benchmark the MSCI benchmark, it's really a combination of REITs, pension funds, institutional funds, and private capital. And since June 2010, that total return is 10.7%. And if you look at our ownership, our partnership with Venterra in our U.S. income fund, our position is, as mentioned on the previous slide, is 37%, which equates to 1.7 billion of the 4.7 billion Venterra portfolio. And as of June 2022, the total return, 12.1%. So in summary, you can see why Venterra is consistently ranked as a really by our Nicola Wealth Real Estate team as our #1 partner in the U.S. We've benefited from healthy double-digit returns during our partnership. It's been a tremendous partnership that we've had for several years, and we look forward to many more working with John Foresi and his team.
Mark, thanks very much. It's great to take a look at that, the long history that we've had with Venterra and how well it's worked for our clients, which brings us maybe to a natural segue into a question, John, for you. And the fact is you and Venterra, your colleagues at Venterra, have a phenomenal track record, and it has been overall since the firm started in the upper teen rate of return, beating major indices both in real estate and in the terms of the indices such as the S&P 500. You've never lost any investor capital on any transaction, and so therefore, as a result of that, you've had much lower volatility in achieving those outcomes as well. So the obvious question is this, or 2 questions, I guess. So how has Venterra done this? What is this secret sauce that has allowed it to outperform the markets and your competitors for so many years?
Okay, so it's a big question. I'm going to try to give a simple answer to. We had one of our investors visit us in our Houston office. It's our head office in the States last month. And so the investor came to Houston, toured the properties, met with our senior team. He's about 70-ish. He was the right-hand person to probably one of the most successful American entrepreneurs in the last 60 years. He's passed away since then. But this individual was, after this business icon passed away, was also a very independently successful entrepreneur. And he spent the day with us, and I'm driving him back to the airport. And this is a pretty sophisticated investor. He's been involved in building some of the most recognizable brands and businesses in America. And he said, you guys have a pretty good organizational IQ, but he goes, I think the real differentiator for you is the investment discipline that Venterra has throughout the organization. So I took that as quite the compliment from someone of his accomplishment. And so when I look at that, you break down discipline? What does discipline mean? And I think just try to go quickly through it. We've got ourselves into an enviable position of just not needing to do deals ever again. And we want to grow, but we only want to grow, as my business partner Andrew Stewart always says, we want to grow in a way that we're proud of that growth 10 years from now. We're able to do it because we had a liquidity event personally in an enterprise software business in the late 90s. And we decided to build a business based on the strength of that capital that was not a dividend generating business. We generate dividends for our LP investors, but we wanted to keep all the capital into the business. And so you do that over several decades, 21 years in running without the owners taking out a distribution or a dividend, and having all that money very profitably reinvested in the business, making investments that others aren't making in our industry, and it's put us in a pretty good position. So it's 21 years of deferred gratification that's put us in the position of just not needing to do deals. That's helpful. Second is the makeup of our IC, our investment committee. So incentives running high performance investment platforms are critical. And what I'm going to mention is just the tip of the iceberg. We could spend 2 hours on this topic easily. No one can be on Venterra's investment committee who is incented in any way on individual transactions or group of transactions. There is no one on quotas that is on investment committee. And the investment committee, the goal is for every member to have 1 foot firmly planted in calculated risk taking and 1 foot firmly planted in calculated risk mitigation. You can't do that if you don't have all the right incentives. We call it the 1 foot principle. So we have a unique long-term compensation methodology for senior people so they benefit from the long-term success of Venterra without compromising that 1 foot principle. And any deal that we do requires unanimous consent of the IC members. And Andrew and I are very, frequently say to our IC members, no one gets fired for saying no to a deal. So it's very, very important from an investment concept, investment principles that we cover just in a few minutes to financially not have to do deals, have the 1 foot principle, have a culture at the senior level that is very long-term oriented. It's not rocket science. It's easy to state, easy to understand. But very difficult to follow, over long periods of time. 21 years in running that. I like to use Charlie Munger's quotes. He's Warren Buffett's partner. He's so candid. He said about the difficulty of making good investments decisions over time, and he said, it's not supposed to be easy. Anyone who finds it's easy is stupid. And so it really is easy to understand, just darn difficult to do. So, and I look at it, we've got really hyper alignment with all of our stakeholders. So we have residents who vote our properties in the top 5% of apartments in America consistently. We have investors who are happy. We have employees who rate it as one of the best workplaces in America. That hyper focus and that discipline results in some unusual things. So we have $5 billion in assets nearly under management. We don't have anyone that raises capital on a full-time basis. And we don't have anyone focused full-time on investor relations because it just sort of hangs together. So that's the secret sauce if you want.
Well, thanks, John. And actually, it segues actually into another interesting question. So you have certainly since I've known you, and certainly since the great financial crisis, been talking about, well, now we have to modify our expectations, and those great returns in the early years will be hard to replicate. But notwithstanding, you keep predicting that. Certainly over the last 10 or 15 years, you've managed to continue to achieve the same great returns you did in the early years. And now today, we're in the middle of a major market meltdown, absolutely increasing interest rates, a higher inflation environment than we've seen for a long time, and a decent chance that we're going to be walking into some version of a recession. So given all of that, what is now your expectation on returns going forward, whether it's a year, 3 years, 5 years, or 10 years? What's your thinking here?
Well, we certainly don't, look at anything sort of less than 10 years. But I know I've been beating the same drum. We've been beating the same drum for a long time, and people are getting tired of it, the crying wolf. But we're going to stick with it, with one exception here. That there's a wild card here. But we've been saying since the financial crisis that if you can achieve long-term returns of 10% or higher, you're going to be in the top quintile or top decile of investors. And we're still holding to that position. It's not what investors want to hear, but it's important that we think that they hear it, because it's very sad when an investor stretches and puts themselves further out on the risk curve than they really want to be. So why would investment returns not be as high as in the past? Well, it's the first chart that I showed you. We still have not addressed the delevering that has to happen in the global economy, which would be suppressive to returns. Money supply growth has been crazy. I mean, it's almost unfathomable if it didn't happen that we had a 40% growth in the money supply in the US from the start of the pandemic to now. Other countries like Canada and Europe, they've been all doing the same thing. That can't continue. And of course, if you have money supply growing quickly, well, more money chasing the same number of goods, you're going to have asset values increasing, which has made everyone, including Venterra, look smarter and better than they are. So I just think it's some humility, some just realism here is in line. Of course, demographics, we talked about it. So demographics, people get older. People are having fewer children. What do retirees do? The baby boomers has been the biggest generation, so they'll be draining down their savings. They'll be selling investments. So if you have more sellers than buyers, then the returns should go down. And then institutional assets, our investors are starting to make imperfect markets, which like ours and other private equity, a little more perfect, not perfect. Here's the big thing that could throw us off of that conservative projection. And it's what I measured in the capital flow section. It's the productivity counterpoint. I mean, I can tell you, I think there's going to be a recession, but last month, I'm just getting ready to head out to the US again. Last month, I was in Austin, Houston, and Miami on the trip, and there's no recessions there. Those places are on fire. The amount of capital, it's just palpable. You can drive by and see the factories being built. And that's a major driver for productivity growth. It's caused Venterra, quite frankly, to raise its long-term forecast for productivity growth, which has been 1% in the States since the financial crisis, to double it to 2.1%. You can't have all this capital flowing in there and not have productivity growth. I think if there's any chance for investment returns to start to hang around where they have been, that increased capital investing in America, which is not happening in very many places around the world, has a chance to offset more now than ever the negative things that I've talked about. So I'm kind of waffling a bit of how pessimistic I'm going to be, because there's pessimism out there, but the amount of capital that's being spent in America to make it more productive is eye-popping. So
that's a segue to another question related to that. So you've been a big fan of the US dollar for a long time, John, and that's obviously, especially in the last year or two, played out incredibly well. But again, going forward, thinking about how things play out from here, do you still feel strongly about the US dollar?
Well, the answer is yes. I've gotten into many debates with Canadians about the US Canadian dollar exchange rate over the years, almost as emotional debates as I've had about cryptocurrencies in the last couple of years. And the noise around the direction of the exchange rate is really short term. It doesn't matter that much if you're not a trader. And I'm going to talk to a slide that I've got, a calculation that we've done that represents that in a bit. But when you have so we are non-qualified bulls on the American dollar. Could there be something that happens in the short term where the Canadian dollar goes a little higher? Yes, but long term, make no mistake about it. And that's because of the things we talked about the exceptionally high amount of R&D relative to, say, Canada that the U.S. is doing. The U.S. faster GDP growth per person that I referenced. The fact that the U.S. is 24% or so of the world economy, but generates 50% of private equity capital, over 50% of venture capital. The fact that the U.S. is share of the global economy, share of GDP of the global economy, this will catch people by surprise, has not declined for 40 years. All the growth of China and the rising developing countries has come out of the hide of Europe and other countries like Canada. In fact, Canada's lost 35% of its market share between 1980 and now. And then if you look at the reserve currency, it's only getting stronger. I mean, if you look at the share of the world's currency transactions, that the U.S. is a party to, the percent that the U.S. dollar represents of foreign mortgages or bonds, foreign currency reserves. They're all at record amounts and they're going even higher. And so, where are you going to go for reserve currency? You're going to go to the euro. They are structurally flawed. They've got a monetary union and incredible disparity with their fiscal policies. You're going to go to the Chinese renminbi. They've got rule of law issues and geopolitical isolations. And so, for all of those reasons, I really think that the U.S. dollar is going to be very strong. So instead of fumbling around and getting the chart up, I'm just going to bring a chart up that only I can see, but I'm going to talk to it. The dollar, the U.S. dollar, Canadian dollar exchange rate, if you're not a trader, is noise. The signal is if you hold on to it, it's not a big deal. So we always suggest to investors to find where the best risk-adjusted rates of return that you can find and go there. Let that lead you. For us, that's multifamily investments in the U.S. But let's take a scenario where a Canadian buys a U.S. Apartment complex or invests in a U.S. apartment complex. And let's assume that the day after they buy it, the Canadian dollar appreciates from 75 cents to 90 cents, or a 20% appreciation in one day. That ain't going to happen. And then it stays there for 10. It stays there for 10 years. That's not going to happen either. It's going to bounce around, right? But just assume that happens to just make the point. If you underwrite a 14% IRR deal over 10 years, and your investment returns are really smashed in the first couple of years with that exchange rate differential. But if you hold it for 10 years, because you're earning 14% per year on average, but just let's assume that is 14%, that dwarfs any exchange rate differential that's going to happen in that period. So even though we assume that the American dollar is going to be depreciated by 20% and stay there for the whole 10 years, you hold the investment for 10 years, you're still at a 12% IRR. Not as good as the 14% that you forecasted, but in that draconian situation, it still works out well for you. So the noise is worried about, if you're a long-term holder, is about what the direction of the exchange rate is. The real signal is go to where you can get the best long-term rate of return regardless of exchange rates.
Yeah. And I think one of the things, John, that's important, and that, I mean, the fact is you're talking about a very extreme set of circumstances, and I think we both agree the chances of anything like that happening are zero because it never has actually happened historically. But I think even if you wanted to manage the currency risk issue, simply deciding to systematically add to a strategy, like in other words, acquiring, yes, say, U.S. multifamily assets, and even if the only way you did that was simply take the income or the profits from that kind of asset class and automatically reinvest it back in, regardless of timing or currency, then you would automatically, through a dollar cost averaging process, effectively negate any currency issue in the first place anyway. So it just wouldn't be, it's just, as you point out, mathematically, it's not really a factor. But it does segue into another question I wanted to ask you about, because you and your team are very intense and analytical from a macroeconomic perspective. And in fact, that analysis tends to drive the markets that you decide to invest in, and in particular from a geographic perspective. Can you explain maybe how you have created this internal analytical ability and how it applies to the way your assets are chosen?
Sure. That's really important. Just as a macro theme, whether it's investing in real estate or anything, I really encourage people to spend lots of front end time analyzing, and then make a few bets. Like really take the bets that you're analyzing seriously, and that's what we do. And so we aren't selling advice. We're doing research really practically because we're going to put our own money on the line and that of our LP investors. I like to call it sort of lunchbuck economics because it's so practical. We have 4 people in our research group just that do pure research, which, you know, for a company our size, that's a lot of people just focused on research. And it's headed by a gentleman who was a former central banker economist. And so enormous amount of time on the front end is spent. And we're not trying to prove that we're smart. We're just hyper focused on the things that we think are going to make a difference. And importantly, it goes through the lens of feeling that every investment decision that we make is going to be a multi-generational investment decision. So it's going to last for long. You think of things differently when you take that approach. And you bring that group of researchers together with our really large acquisition team who spend nothing but looking for existing apartments to buy, looking for pieces of dirt on which we build a new complex. That's 20 people. Each year, those people look at a high level at about 2,500 deals. Some of them go in the garbage can really quickly, but they do deep dives. We got like an underwriting model, it's about 450 lines long, of 600 or 700 deals that get full underwriting. And we may do 3 deals, and we may do 10 deals in a year, but it's a very small fraction of the overall deals that we will look at. So we mesh the pure research group, headed by a former central banker, with our acquisitions group that gives tons of real-time feedback. I mean, like daily would be too long. They're in the market all the time. You combine those two with an approach of our culture of that we're pulling the trigger very few times and we're going to be married to this asset forever. You think about things differently when you make decisions, when you have that kind of long-term horizon. You prioritize differently, and when you have a vision of, you know, it's 2 generations, it's 3 generations. I want to end it with a point that 2 points here that are really, I think, really important. As I was talking a number of years ago with someone who headed the family office for a billionaire, and it was interesting. This billionaire didn't have a dollar invested in public equities or public securities of any kind, debts, bonds, etc. And when he was asked, you know, you got a lot of money, you should have some in the public markets for liquidity. He said, well, I've got enough cash flowing private investments that the liquidity is not an issue. And he said, the reason I do this is that in private markets, I can just keep asking questions. I can just keep digging until I am comfortable that I've got information on that potential investment that puts me in a preferential position. And in fact, if I even attempted to do that in the public markets, I'd be thrown in jail because it would be illegal. But it's perfectly legitimate in the private markets to keep digging until you get all the information.
So you mean there's no insider trading in private assets? That's really what you're trying to say?
Yeah, I assume not. It's pretty hard to do that. But people can always tell you no, and that they're not going to give you that information. And they can tell you quite emphatically beyond no. But you could still ask. And so that's an important point. And I think in the end, we overlay it with a decision-making process that says there are 3 things that we're looking for before we pull the trigger. And most of the world is focused on just one. First is alpha returns, outside performance, and I think everyone looks for that. 2, we really focus on low beta or low volatility. And third, we only want it. We can. We don't. If we look at something that's going to be a short-term flip, we're just not interested. So long duration, and if you focus on all 3 of those, you end up having really good assets. You pull the trigger very rarely, and the decision making and the quality of the returns that you end up getting benefit inordinately by having a really inordinate amount of research and analysis that goes on at the front end. So that's basically it in a nutshell.
So John, how do you see the impact of supply and demand in housing, specifically in multifamily, impacting multifamily performance, let's say over the short to medium term?
Yeah, short term is going to be a negative impact. Okay, I just to be direct. So there's 800,000 or so single-family homes under construction currently, and 893,000 multifamily homes under construction. We haven't seen those kind of numbers in single-family since 2006 and 7, and quite frankly, in multifamily, we haven't seen those numbers since the 1970s. Now the population was much lower, and so it's not as dramatic here. But that's a big part of that is the backup of supply created by supply chain issues over the pandemic. There's still a lot of demand out there. 4.8 million Americans are going to turn 32 next year, which is the peak year for family formation. And millennials are going to be moving into their prime years. It's going to be even bigger than Gen X and the movement in the early 2000s. Supply is not going to come on all at once. It's going to be over 23 and 24. It will have a negative impact in the quantities that we're talking about. But here's the key thing. We're in the markets all the time, and it's not in the published figures right now. We are going to see a dry up of supply like we've rarely seen before. And that, the developers we're talking about, it's pencils down. It's actually, I think it's a really good time to develop right now because in 25, 26, the product that's getting delivered is going to come into a dearth of supply. There is going to be an excess supply, not fatally so, but there is going to be an excess supply over the next 2 years. And as long as you put that into your underwriting assumptions, you get the right pricing point, the right entry point, you can still make good returns. It's just, I don't want to mislead anyone and say that supply is not an issue. Supply is only an issue if you pay too much for the asset given the amount of supply that's coming. You just have to understand what's coming. And again, it's where the supply is critical. So a hybrid work from home is absolutely working and here to stay. Remote work is not obvious that's going to be a winner. And so there's a number of communities that are remote that have had like Bozeman and Boise, Idaho, and Bozeman, Montana, that are just going to get really hit as the work remotely starts to get clamped down. So, yeah.
So let's talk about, so then that's actually not a bad segue into the, we've seen obviously public markets, both in fixed income and in equities globally, take a significant beating this year. In fact, arguably the combined impact, let's say on traditional balanced portfolios, is one of the worst this year it has ever been, including the great financial crisis or the dot-com bubble. So when I ask you, all right, in very tough investment environment, big downturns, how has multifamily performed in that kind of environment?
Yeah, okay. It's not immune from getting hurt, but it's more resilient than the sectors you've mentioned, and the results prove that. So, in our 21-year time period here, we have two major downturns. We have the dot-com bubble, and we have the global financial crisis. And the pandemic was a real big downturn, but it was so short-lived that maybe it's not worth mentioning here. But in 2001, effective rents were down 3.2%, and occupancy at the NADAR was down 3.4%, which is a hit of 6.6% to revenue. Now, if you let that go all the way down the average income statement of a multifamily property, that equates to a 21% reduction in NOI at the worst point. And that's kind of that NOI, net operating income, is what these assets get valued of. So it was down 21% for a typical property. Public equity markets during that period were down 46%. So yes, hurt, but not hurt nearly as bad. In the global financial crisis, occupancy was down 3%, rents were down 5%, so a total revenue hit of 8%. NOI was down 26%, but the public markets were down 53%. So the global financial, and really important, is the resiliency, which I just talked about, and the speed of recovery is much better. So it's more resilient, multifamily, all else being equal, and it recovers quickly. So in the global financial crisis, rents and occupancy got back above their previous high water mark in less than 3 years. It took public equities 5.5 years to get back. It took home prices, single family home prices, 10 years. Asset values were even better. So there was no hit to, in the dot-com bubble, there was actually no price reduction in multifamily properties in 2001. In the global financial crisis, they went down in value. The per unit value went down by 16%. and it lasted for only 1 year. It snapped back pretty quickly. By 2010, pricing was above its 2008 level. It's kind of like this necessity of life is gives it the stability of the of this asset class than others. It's not immune. Right now, we're going through a period where roommates are doubling up, people are moving back with their parents, and or with relatives. But we've seen this movie play before. As long as you wait it out, it doesn't last usually more for a year or two at most.
Okay.
But so the answer is more resilient.
So a couple of the areas of focus for you and Venterra for the last few years has been in the Houston area and the Tampa area. And I'm sure a lot of our clients would wonder, okay, well, how does climate change figure into your underwriting and the risk assessment that you feel you're taking on by choosing to acquire assets in those jurisdictions?
Yeah. Well, we climate change from our perspective is real. The results are real. How it's all what's causing it is not that clear, but certainly there's an impact there. So right from we started, we put a significant weighting on it, thinking about climate change the entire time, and it does get factored into our decision making. So my business partner, Andrew Stewart, is an engineer and an artificial intelligence expert. He's worked a lot with leading researchers in leading U.S. universities to develop our own proprietary models to look at right down to the street level, right down to the address level of the probability of certain properties being hit. And so that's a lot of hard work. It's very complicated, and there's not a 10-step process here. You got to figure it out, and you got to make some assumptions. But we do take it very seriously. So, I don't want to say I can't guarantee these same results going forward, because maybe there's been some luck involved. There always is in business. But every property we buy is done with this analysis taken into consideration. So if you look at Harvey, Hurricane Harvey back in 2017, it hit Houston, and then a week later, Hurricane Irma hit Florida. We had 28 properties in the path of that hurricane. And then, of course, everyone knows about Hurricane Ian that just happened this past year. And we had 44 properties that, not the direct hit, that it was in southwest Florida, but we still got hit. And so we had 44 properties that got hit during those three hurricanes. And we only had one as a result, only one property that had an insurance claim. I mean, you get some shingles that get popped off, and you get some, when you get horizontal rain coming in at 100 miles an hour, you get some penetration, but nothing big enough, except for at one property, to do an insurance claim. So one property insurance claim over 14 years. It's always a risk calculation, and we will not move forward unless we're comfortable with the risk. It's not a guarantee, but you look at it. Somewhere like Houston, somewhere like Tampa, or like Orlando, those are cities that have a real purpose. So if you look at somewhere like Houston, people say, well, it's really got exposure. Well, it does have exposure, but quantify the exposure. If you ever look at the mouth of Galveston Bay, you can go up on Google Earth. It's a very, very small, I don't know if it's a kilometer and a half, very small area. It's not that it's impossible that it takes a direct hit with an associated storm surge. I'm not sure it's ever happened. But it doesn't mean it can't happen, but it's a low probability. And then on top of that, you've got an energy infrastructure that can't be built somewhere else in the world. And so, literally a week after Harvey hit, the mayor of Houston said, we're open for business. You had in New Orleans that has, say, not the same kind of reason for being in terms of energy infrastructure. They still haven't recovered their population. So it doesn't matter where you invest in. There's parts in Houston that the center city of Houston is 50 feet above sea level. There are parts that are lower lying. It's a great question. You cannot answer it in 10 minutes. I think the important thing is that we do a ton of analysis. We take it very seriously, and it gets formulated into every one of the decisions we make.
So let me maybe wrap up our session today with 2 or 3 questions, actually, for both John, you and Mark. And let me start with this one. What's your view on we call it build to rent or build to own, as opposed to, say, the acquisition of existing mature assets, and maybe the pluses and minuses of both? So John, why don't we start with you, and then Mark, go to you.
Yeah. So I'd say that build to own, or it is single family rentals, if you will. They're it's just so people that may not be aware. They're like developments, like neighborhood subdivisions, but they're rental houses, and so they have smaller yards, but they still have their own house. But they have a common swimming pool, common workout facility, common clubhouse. We actually really like the idea. We think it's got legs to it. We think it's going to be around for a long time. We think it fills a hole in the marketplace, particularly given the unaffordability of single family ownership. We love the space. Why aren't we in it? It's about pricing. The amount of capital from both multifamily developers and single family developers that entered the space that was between the two in the marketplace was phenomenal. So we think it's got a waiting period now to absorb the capital that's been put in there. But if you ask me if if it meets a market need, yes, it does. If we think it's going to be around long term, yes, we do. And at some point, we'd hope to be able to enter that space. We just haven't been able to get the right pricing to enter the space yet. So we're actually, even though we're not in the space, we're big fans of it.
Okay, Mark, any thoughts?
Yeah, so I mean, great comments, John. The Our team has been very successful at acquiring existing properties, both in the U.S. and Canada, and providing value add specifically for industrial, say light office, self-storage, and sometimes multifamily. But it's very difficult for our team to buy new and shiny and pay full retail pricing and give alpha returns to our clients. So we have adopted 3 or 4 years ago a plan to build to own, and we're doing that a lot in Canada and certainly in the U.S. And it specifically applies to residential. I mean, it's interesting how John and his team can acquire existing multifamily in the U.S. and relatively newer product. It's not 30, 40 years old. I mean, in the odd instance he has, but in most cases they're probably 1 to 10 years old, and he can acquire those assets at relatively good pricing, and then his team can get in there and use their superpowers to execute and deliver those returns. We cannot do that in the US. It is very difficult for us in Canada. We cannot acquire existing multifamily buildings, especially newer ones, and get those returns. So that's why we've adopted the build to own program.
Okay, thanks. So look, I have one more question actually, again, for both of you, and maybe a good way to wrap up our webcast today. So maybe both of you could answer this question. Can you summarize, as you see it, the biggest risks and the biggest opportunities for Canadian investors in U.S. real estate as you see it? John, you want to take a run at that first?
Biggest risks and biggest opportunities. Okay, the biggest risks would be bad election outcomes. Okay, so in the sense that it's on both. I'm not trying to make political commentary here in terms of which party gets elected. What does bother me is the election denying on both sides, and I think that goes sort of the heart of a democracy. I'm hoping that we start seeing a group of leaders that emerge that before the election is finalized, they agree to accept the results. I think that just sort of goes fundamental to democracy, and it's important. I would say that to counter that, I just want to throw some stats out that are staggering. The U.S. always, it feels like it's sort of the wheels are coming off, and they just keep sort of going forward, and it works. But democracy was meant to be messy, right? It's a contest of ideas. And we came across some stats that are, I thought, staggering here. And it does give me hope over time for the U.S., even though it does seem that the U.S. is more polarized than ever. And that is a risk, so I don't want to deny that. But, it's interesting that government spending on media, it's not a Canadian thing. It's a Western world thing, with the exception of the U.S. So Germany spends, this is all per capita based. Okay, so it's for the size. It takes in different sizes into consideration. Germany spends 148 times more on public TV than the U.S. does. The U.K. spends 42 times more than the U.S. Canada 33 times more. Japan 29 times more. Italy 29 times more, and France 23 times more. So the U.S. is relatively different that they don't fund public broadcasting. So you have these different private sectors that it comes across as very messy and ugly. I think in the end, America, as Winston Churchill said, I'll butcher one of his phrases, they get it right in the end. So, but it does feel like a risk right now, given the political system. I think the risk really also, the biggest one is one that's in our control, which is discipline. So we talked about that before, is not letting the markets, not taking the wrong signals from the markets and just doing lots of analysis. I think the opportunity, I would say, is a profound one. It's a multi-generational one that I mentioned, which is the repatriation of American manufacturing and creating an American-centric supply chain is going to be looked back generations from now as a turning point in America's prosperity. So I think that's the big opportunity, and finding where that capital is going and investing around where that capital is landing specifically in America is a phenomenal opportunity. It doesn't really exist at the scale that America is offering anywhere else in the world.
All right. Thanks, John. All right, Mark, take a run at this.
Yeah, okay. Just quickly, I must admit, when John Foresi brought up political environment, it can be a bit scary, but I take comfort that the U.S. has got a big, powerful economic engine. So that's what I'm always looking at. So our team is very bullish on multifamily, and it's the safest asset class by far, and that really was reaffirmed during COVID. So three quick things on the risks. Obviously, interest rates. Financing on new acquisitions, renewals, or new construction. It's going to be very challenging for the undercapitalized players. Geography, John's talked a lot about it today. It's really important for both good and bad. You've got to really have your lights on and pick the right markets, and that's what John Foresi's team does so well. Whether it's climate change or tax-friendly states or government regulation, tracking the migration trends, the manufacturing growth, rent control, all those things are really important and you can't get it wrong. The last is supply and demand. You just got to really monitor that market. John did mention that there's more supply. I think the risk is low in the short to medium term. And then finally on opportunities, one thing I've always liked about the U.S. market as opposed to Canada, it's 10 times bigger, and it's just got great liquidity in that market. But there is a capital squeeze going on, and I think that's going to work in our favor. And as a result of the interest rates rising, this is going to open up a lot of opportunities for John's team, John Foresi's team, for our team, to get assets off market on quiet basis at very good returns. And then the last is, it's a biggie for us, and I'm sure it is, it plays into John Foresi's team, is the lender environment. Debt plays a really important role in real estate, and there's a flight to quality by the lenders. And I'm going to tell you that the borrowers such as Venterra and Nicola Wealth Real Estate, we're going to benefit in this environment as the lenders tighten the screws.
Yeah. Well, thanks, Mark. Well, John, just as we wrap up, and I think I'm speaking on behalf of Mark and myself here, first off, we're incredibly thrilled and proud to have had such a long partnership relationship with Venterra going back 16 years now. And we want to thank you for the fact that you and your team have created an incredible result for our clients over a very long period of time during more than one crisis, and consistently delivered results that, quite frankly, were beyond expectations. And I guess the great news from today's discussion is that while there's no easy, low-hanging fruit in front of us, your view basically of the future is that there's just as much promise in the future over the next decade or so as we have potentially seen over the last 10 to 15 years. So that's highly encouraging. So John, first off, please accept our thanks for doing this, participating in this. I know our clients are going to be really happy to watch this when it's all put together. And Mark, again, thanks to you as well.
Well, thank you, John. I just want to say as well that both Andrew Stewart and I and the rest of our senior team are just, we couldn't be happier with the partnership that we have had over 16 years with Nicola. As you know, you replaced some institutional investors that we had at the time, and they're just right from the very beginning. There was a great cultural fit between the two organizations, and certainly a good business fit. we couldn't be happier with the partnership as well. We feel very privileged to have you as a partner in your organization, and we love doing work with you, and we look forward to the next 16 years together. I think we can accomplish together a lot of great things like we have in the past. So thank you very much for the partnership as well.
Well, thanks again, John, and then I am looking forward to how this is going to play out in the future as well. So great. Again, thanks, and thanks to everybody else for being here as well.